Welcome back to the Daily Crypto Deep Dive. Today we are talking about XRP, and not the surface-level version, not the Twitter version, not the Moonboy $100 prediction version. We're asking the real question. Is XRP actually building the infrastructure for a global settlement layer? Or has retail been holding on to a narrative that hasn't fully materialized? Because XRP is one of the most polarizing assets in crypto history. It has survived multiple cycles. It has outlived entire ecosystems. It has fought regulators. It has maintained a loyal community through brutal drawdowns. And yet, despite all of that, it still hasn't reclaimed its all-time high in a meaningful, sustained way. So the question isn't whether XRP has potential. The question is whether the potential aligns with reality. Let's start by clearing something up that most people still confuse. Ripple and XRP are not the same thing. Ripple is a private company. XRP is a digital asset that exists on the XRP ledger. Ripple owns a large portion of XRP supply, much of which is placed in escrow and released on a scheduled basis. Ripple builds enterprise payment solutions. XRP is designed to act as a bridge asset for liquidity. That separation matters, because when you see headlines about Ripple partnerships with banks, that does not automatically mean those banks are holding or using XRP at scale. RippleNet is the network of financial institutions using Ripple's messaging and settlement software. On-demand liquidity, or ODL, is the product that actually uses XRP as the bridge currency to move value between fiat pairs. That's where the real use case sits, not in speculation, not in retail trading, in cross-border liquidity provision. And that's a massive market. Global cross-border payments exceed $150 trillion annually. The current system, largely dominated by SWIFT, is slow, capital-intensive, and requires pre-funded Nostro and Vostro accounts. Ripple's pitch has always been simple. Free up trapped liquidity, settle in seconds, reduce counterparty friction, and use XRP as the neutral bridge. Technically, the model makes sense. Economically, it's efficient. The challenge has always been adoption. Now let's address the elephant in the room: regulation. The SEC lawsuit fundamentally altered XRP's trajectory. When the SEC alleged that it was an unregistered security, exchanges delisted it. Institutional players stepped back. Liquidity thinned. The narrative shifted from adoption to survival. And for years, XRP traded under a regulatory cloud that suppressed upside momentum. Even partial legal clarity hasn't completely restored institutional confidence yet. But here's the nuance. The lawsuit may have delayed adoption in the United States, but it didn't stop Ripple from building internationally. Ripple expanded aggressively in Asia, the Middle East, and parts of Europe. The company positioned itself in jurisdictions that offered clearer digital asset frameworks. That global strategy matters because cross-border payments are not a US-only market. Now let's talk numbers, because this is where the speculation meets reality. If XRP were to reach $5, depending on circulating supply, we're talking about a market capitalization in the hundreds of billions. At $10, you're pushing toward levels that require massive capital inflows. That doesn't mean it's impossible. It means the path requires real institutional scale adoption, not just retail enthusiasm. For XRP to sustain $5, it would need either a major shift in utility-driven demand or an aggressive speculative cycle where capital rotates heavily into large-cap altcoins. For $10, you likely need both: a broad crypto bull market and tangible evidence that XRP is embedded in high-volume settlement flows. Now here's the important distinction. XRP does not need to replace SWIFT to succeed. It needs to capture a slice of the liquidity routing market. Even a fraction of cross-border settlement flowing through XRP could justify a significantly higher valuation than today. But that fraction must be measurable. It must be visible in transaction volume, liquidity depth, and institutional balance sheet integration. So let's evaluate the bull case properly. XRP transactions settle in 3 to 5 seconds. Fees are negligible. The network is energy efficient. The ledger has been operating for over a decade. It has not suffered catastrophic failures. Ripple has partnerships with financial institutions. There is a stablecoin initiative emerging through RLUSD. There is ongoing dialogue with central banks about CBDC interoperability. All of that suggests infrastructure positioning rather than meme speculation. Now the bear case. XRP supply concentration remains a concern. Ripple's escrow releases create perceived sell pressure, even if much of it is recycled. Banks historically prefer systems they can fully control. Stablecoins increasingly dominate cross-border transfers. Central bank digital currencies could bypass bridge assets entirely. And competition exists not just from SWIFT, but from Ethereum-based settlement systems, private blockchain rails, and even traditional fintech platforms. The real question becomes this: does XRP become indispensable infrastructure, or does it become optional middleware? If XRP becomes optional, upside is capped. If it becomes indispensable, upside expands dramatically. Now let's bring this down to portfolio reality. If you are constructing a crypto portfolio today, XRP is not a venture play like a new layer 1. It is not a meme volatility trade like smaller caps. It sits in a large cap utility narrative bracket. That means its role in a portfolio should reflect asymmetry, but not overexposure. 5 to 15% allocation makes sense for someone who believes in the infrastructure thesis. 30 or 40% is narrative concentration risk. Because the truth is this: XRP's upside depends on execution by a private company operating in a highly regulated financial environment. That introduces variables beyond pure decentralized adoption. Let's talk liquidity cycles. XRP historically performs strongly during broad altcoin expansions. When Bitcoin dominance falls, capital rotates into high recognition assets. XRP often benefits from that wave. But it tends to lag early cycle momentum. It requires confirmation and narrative ignition. That means timing matters. Buying XRP during despair historically has produced better risk-adjusted returns than chasing it during euphoria spikes. And here's something most people don't calculate properly. Even if XRP captures a portion of settlement flows, price appreciation depends on token velocity. If institutions use XRP purely as a transient bridge asset without holding it, price impact is muted. For price to sustain higher levels, some portion of liquidity providers must maintain inventory exposure. That dynamic is crucial. Now let's zoom out. Crypto is maturing, regulation is forming, institutional rails are being built, stablecoins are integrating with banking systems. In that environment, infrastructure assets have more durable narratives than pure speculation tokens. XRP positions itself as infrastructure. The question is whether that positioning converts to measurable dominance. So here's the rational conclusion. XRP is neither a guaranteed $10 rocket nor a dead relic. It is a high-liquidity, battle-tested asset tied to a real company executing in a complex market. Its upside exists. Its risks are structural, not imaginary. Its valuation will ultimately reflect usage, not hope. If you hold it, the intelligent stance is this: understand what you own. You own exposure to cross-border liquidity innovation. You do not own a guaranteed central bank backbone. You own a probability distribution. Now, before we continue, a quick word for anyone holding XRP or any digital asset long-term. Self-custody matters. If you're serious about security, consider a hardware wallet. I personally recommend Ledger for cold storage because it reduces counterparty risk. I'll leave the link in the description. If you're accumulating XRP for the long run, protecting it should be non-negotiable. Now back to the thesis. One of the most overlooked aspects of XRP is psychological resilience. The community has endured regulatory attacks, exchange delistings, and prolonged sideways markets. That persistence creates network stickiness. When retail confidence returns to crypto broadly, XRP does not need to reintroduce itself to the market. Recognition already exists. But recognition alone does not drive valuation. Usage does. So watch the metrics that matter. ODL volume, institutional partnerships converting to balance sheet integration, regulatory clarity in major economies, stablecoin interplay, liquidity corridor expansion. Ignore influencer price targets without liquidity modeling. The final layer to consider is macro. If global liquidity expands, if interest rates ease, if risk assets reprice upward, XRP will likely participate. In a tightening environment, infrastructure tokens may outperform speculative small caps, but they are still risk assets. So here's the bottom line. XRP sits in a strategic middle ground. It has more tangible use case alignment than many altcoins. It has more regulatory baggage than Bitcoin. It has more corporate alignment than decentralized maximalists prefer. That hybrid nature is both strength and vulnerability. If Ripple executes and regulatory clarity solidifies, XRP can reprice meaningfully higher. If adoption remains incremental and stablecoins dominate settlement rails, XRP may underperform relative to newer ecosystems. The mature position is not blind optimism or reflexive dismissal. It is conditional conviction. Understand the variables, size your exposure accordingly, protect your assets, and watch the data, not the noise. Drop your thoughts in the comments. Are you holding XRP long-term, or do you see it as a cycle trade? Smash like, follow for daily analysis, and as always, we will see you at the top.